The market doesn't punish fear first. It punishes confidence that thinks it understands what's coming next. Most people don't lose money because they panic. They lose money because they feel certain. Outside the market, confidence is praised. In school, confidence helps you speak up. In business, confidence helps you lead. In life, confidence signals competence. So people carry that belief into investing. They assume confidence equals clarity, conviction equals strength, certainty equals control. It feels reasonable. It feels earned. It feels like maturity. But the market operates under a different physics. Here is the uncomfortable truth most investors never accept. The market does not reward confidence. It exploits it. The more confident you are, the less you question your assumptions, the slower you react to new information, the harder it becomes to admit structural error. Confidence reduces psychological friction, and friction is often the only thing stopping people from doing irreversible damage. This is why the biggest losses often follow the strongest conviction. The worst drawdowns happen after a perfect thesis. The most painful crashes come right after "I've seen this before." Confidence feels like control, but in markets, it often functions as blindfolds. Let's break this down without emotion. Not motivational, not moral, just mechanical. Stage 1. Pattern recognition illusion. Confidence usually begins honestly. You study markets, survive a few cycles, experience wins after correct analysis. Your brain does something very human. It connects outcomes to intelligence. I understood this move. I saw it earlier than others. I was right when most were wrong. This is not arrogance yet. It is pattern recognition. The danger begins when the brain upgrades pattern recognition into predictive authority. You stop asking, "What could invalidate this?" and start assuming, "I know how this behaves." The market never promised consistency. Your brain invented it. Stage 2. Narrative lock-in. Once confidence forms, narrative hardens. You no longer hold a position. You become the position. Every new piece of information is filtered through one question. Does this support what I already believe? Supporting data feels like confirmation. Contradictory data feels like noise, manipulation, or ignorance. This is where confidence turns dangerous. Because markets don't reverse suddenly. They drift away from your thesis quietly. And confident investors don't notice drift. They wait for validation that never comes. Confidence does something subtle to risk. It doesn't make people reckless immediately. It makes them comfortable. Comfort leads to slightly larger positions, slightly tighter stop discipline, slightly more leverage, slightly more "this time is different" thinking. Each step feels rational in isolation, but together they form an invisible expansion of exposure. The investor believes risk is unchanged, but reality says otherwise. Confidence doesn't remove risk, it hides it from perception. When reality finally diverges too far to ignore, confident investors react last. Why? Because adaptation feels like self-betrayal. Changing your mind means admitting misjudgment, letting go of identity, surrendering narrative control. So confidence delays action, and delay in markets is often more expensive than error. Imagine an investor who correctly identifies a macro trend. They understand liquidity cycles, analyze monetary policy shifts, anticipate sector rotation. The thesis is structurally sound, but confidence creates a fatal distortion. They assume timing will eventually align, drawdowns are temporary, volatility equals opportunity. What they ignore: capital constraints, opportunity cost, path dependency. They are right about direction, but wrong about survivability. The market doesn't care about correctness. It only cares about alignment over time. Confidence blinds investors to time as a risk variable. Confidence doesn't fail loudly. It fails quietly, slowly, politely. It convinces you to wait when you should reassess. Here is the insight that changes how you see investing forever. The moment you feel most confident is usually the moment your learning has stopped. Confidence signals internal closure. Markets punish closure. The goal is not to eliminate confidence. The goal is to never let confidence finalize your thinking. Professional investors don't operate with certainty. They operate with conditional belief. They don't say, "I know." They say, "This works unless X changes." Confidence feels good, but flexibility survives. Most investors confuse confidence with conviction. They sound similar, they feel similar, they are rewarded similarly outside the market, but structurally, they are opposites. Confidence says, "I believe this is right." Conviction says, "I know exactly what would prove me wrong." Confidence is emotional closure. Conviction is conditional commitment. A confident investor asks, "How big can this get?" A convicted investor asks, "Under what conditions do I exit without hesitation?" Confidence attaches to outcomes. Conviction attaches to process and invalidation rules. This difference determines survival, because markets don't test optimism, they test exit discipline under uncertainty. Here is a counterintuitive reality. The market often favors investors who feel slightly uncomfortable, not afraid, not paralyzed, just uncertain enough to stay alert. Why? Because uncertainty keeps the mind open. Low-confidence investors recheck assumptions, reduce position size naturally, update beliefs faster, accept being wrong earlier. They don't need to defend a narrative. They don't need to look smart. They don't need to be right publicly. They only need to remain solvent. Markets reward adaptive humility, not self-belief. Confidence closes feedback loops. Uncertainty keeps them alive. Let's map this precisely. Level 1. Fear-based uncertainty. Indecision, constant second-guessing, overreaction to noise. This is not strength. This is emotional fragility. Level 2. Informed uncertainty. Optimal zone. Clear thesis. Predefined invalidation points. Position sizing that allows error. Willingness to exit without identity loss. This is where professionals live. They are not confident. They are prepared. Level 3. Narrative confidence. Strong belief. Emotional attachments. Selective attention. Danger zone. Level 4. Identity confidence. Position equals self-worth. Exiting equals humiliation. Loss equals injustice. This is where portfolios die quietly. Most investors don't collapse in level 4. They linger, and lingering is lethal. Experience doesn't eliminate confidence risk. It refines it. Veteran investors don't make rookie mistakes. They make elegant mistakes with size. They have longer memory, have survived past crises, and have frameworks that worked before. So when confidence forms, it feels justified. Unseen worse. This reminds me of, markets always overreact. Sometimes they're right. But markets don't repeat. They rhyme with different consequences. Experience can sharpen perception, or it can fossilize it. The market doesn't respect tenure. It respects continuous humility. If part of you resisted this, that resistance is the signal. Let's be precise. Confidence is not useless. It is dangerous only when misused. Confidence should exist only in your process, your risk rules, your execution discipline, never in outcomes, timing, predictions. You can be confident that you will exit when conditions break, you will size positions conservatively, you will survive multiple wrong calls. You should never be confident that this can't fail, the market is wrong, time will fix this. Confidence belongs below the surface, not above it. Here's the insight that permanently alters how you invest. The market doesn't punish confidence. It punishes thinking that has stopped moving. The most dangerous phrase in investing is not, "I'm scared." It is, I'm sure. Survival comes from provisional beliefs, reversible decisions, constant openness to disconfirmation. The best investors don't sound confident. They sound measured. They leave space for reality to speak. Confidence makes you feel safe. Markets are not built to protect safety. They are built to expose certainty. And the ones who last are not the most confident, but the ones who never stop listening when the market quietly says, "You might want to rethink this."